Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Apollo Pipes, hosted by Antique Stock Broking. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manish Mahawar from Antique Stock Broking. Thank you, and over to you, sir.
Thank you, Stephen. On behalf of Antique Stock Broking, I would like to welcome all the participants on the call of Apollo Pipes. From the management, we have Mr. Samir Gupta, Managing Director, Mr. A.K. Jain, CFO, and Mr. Anubhav Gupta, Group Chief Strategy Officer on the call. Without further ado, I would like to hand over the call to Mr. Samir Gupta for opening remarks, post which we will open the floor for Q&A. Thank you, and over to you, Mr. Gupta.
Good afternoon, everyone, and thank you for joining us on Q3 and 9 months FY22 earnings call to discuss the operating and financial performance. First of all, wishing all the participants and their family a very happy new year. I hope you all had the opportunity to go through our results presentation, which provide details of our operational and financial performance for the third quarter and 9 months ended on 31st December 2021. To begin with, I am pleased to share with you that we have reported a stable performance during the quarter, with our sales volume growing by 9% YOY to 12,520 metric tons. Volume growth was driven by a healthy contribution from the HDPE, CPVC pipes and value-added product segments. Furthermore, expansion of product portfolio, improved reach in newer geographies, and addition of new brownfield capacities assisted volume growth. Over the next few quarters, we anticipate this sales performance trend to strengthen, led by an improving demand environment, expansion in addressable markets, and a sustained uptick in utilization levels. Moving on to the operational front, we continue to keep strong focus on value-added products, the building material products side, which continue to gain traction. From a product basket standpoint, we continue to witness a positive traction in inquiries for Apollo bath fittings and CPVC piping system. We remain confident that these products, along with our other value-added products offerings, will enhance our reach and strengthen sales going forward. In addition, we are aiming towards optimally utilizing our capacities over the next 2 years, which will also help augment sales volume going ahead. On branding, we have recently appointed Tiger Shroff as our brand ambassador and launched social media campaign during Q3 FY22, which has generated strong response on social media platforms. We are excited to share that our commercials witnessed more than 50 million views in 2 months. We are expected to launch our TV commercial starting Q1 FY23, which will further strengthen our brand positioning in the market. To conclude, I would like to state that we are constantly working towards enhancing our presence across existing and new high potential geographies. Given that we are having healthy cash flow generation and capacity utilization levels are inching up, we are planning our next phase of capex. We are still on design stage, but I can tell you that any new capacity will be mainly in value-added products where we see strong demand trends. Plus, bulk of capex will be funded from internal cash flow. Going forward, we expect to deliver a robust performance in the quarters to come and further gain momentum on the back of improved profitability, strategic expansion in key geographic areas, and better brand acceptance. Now, I would like to invite Mr. Ajay Jain to run you through the key financial highlights of the quarter and 9 months for the period ending December 31st, 2021. Thank you.
Yeah. Good afternoon, everyone. I will briefly cover the financial performance during the quarter and 9-month period ending December 31st, 2021. The company delivered a stable operational and financial performance during the quarter, driven by an uptick in demand and consumption in key domestic markets. Revenue from operations for the quarter stood at 190.8 crores as against 128.1 crores in Q3 FY21, higher by 49%. However, 9 months FY22 revenue growth was better at 56% YOY, with revenues of 536.6 crores against rupees 343.9 crores last year. Sales volume for the quarter stood at 12,520 metric ton, reporting a growth of 9% as against 11,445 metric tons, and 9 months FY22 sales volume stood at 37,440 metric tons as against 34,346 metric tons, up by 9% again. On the profitability front, EBITDA for the quarter declined by 15% YOY to rupees 21.6 crores versus rupees 25.5 crores in Q3 FY21. EBITDA margin, which stood at 11.3% in Q3 FY22, was lower by 857 bps YOY. EBITDA for 9 months FY22 stood at 65 crores as against 47.2 crores, growing by 38% YOY, with EBITDA margin at 12.1% for 9 months FY22 versus 13.7% during corresponding period last year, lower by 160 bps YOY. Going forward, we anticipate EBITDA margin trends to sustain. During the quarter, we witnessed a sharp increase in depreciation led by new plant commissioning, which was partially offset by a reduction in financial costs. Depreciation costs stood at 6.7 crores in Q3 FY22 as against 4.4 crores in Q3 FY21, growing by 51%. Net profit for the quarter stood at 11.4 crores, declined by 30% YOY when compared to 16.3 crores in Q3 FY21. Net profit for the 9 months FY22 grew by 23%, stood at 34.2 crores as against 27.8 crores in 9 months FY21. Net margins during the period stood at 6.4% as compared to 8.1% in 9 months FY21, lower by 173 bps. On the balance sheet front, our net cash position stood healthy around 6.5% in H1 FY22. Any new capex will be majorly funded from internal cash flows without stretching our balance sheet. On the working capital front, additional raw material requirements at newly commissioned capacities may moderately impact the inventory levels in the near term. However, our endeavor remains on maintaining our overall working capital cycle at stable levels. With this, I would now request the moderator to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Madhav Marda from FIL. Please go ahead.
Yeah, hi, once again, thank you for your time and good afternoon. I just wanted to understand that, volumes for us have been better versus some of the players in the same industry that have reported so far. So just wanted to understand, how we achieved that good volume delivery and how much of an impact did our business have from the, channel destocking which has happened in plastic pipes overall.
Hi Madhav, Anubhav here. Good morning. So if you look at our volume performance, which we have outperformed versus our industry PR, the reason is that our value-added product category, which is more tilted towards building material, that has done really well in the third quarter and in the first 9 months also. If you look at some of our categories like CPVC, which is growing at above 70-80% on YY basis, the fitting solution, the volume growth has been 20 to 30% on YY basis. Then the other products like bathroom fittings and water tanks and solvents put together, even they are growing at 60-70%. So these are the broad 3 value-added product categories which have been doing really well for us. And the commoditized sales and the commoditized sales is growing at like flattish. So that's why we have been able to perform better than the industry peers so far. And given on the Destocking, yes, I mean, it did impact the overall volumes, because the CPVC prices were pretty much volatile in the 3 months of third quarter. If you see, first there was the increase and then they came off. So our initial expectations were a bit higher when we started the quarter, but because of volatility, there was some destocking. So we would say we could have done much better in the third quarter if the volatility would have been lower in the PVC resin pricing.
Got it. And when you say 70-80% or 60-70%, that's top line, right? Like, could you help us with the volume growth for the building material category?
Yeah. So CPVC, I mean, the realizations have been stable, right? So whatever growth we mentioned, this pertains to the volume growth, right? Okay. In the bathroom fittings and water tanks also, the realizations have been stable. So whatever growth we said, it is the volume growth. And in the fitting solutions, I mentioned 25-30% volume growth only. The value growth is a bit higher.
Okay. So it's basically the PVC side of things, the more commodity grades probably, like you said, have been very weak, and that's why. Okay, got it. So it's a complete product mix kind of impact.
Yeah, it's the improvement in the product mix towards value-added product, which has boosted the sales value. And commodity, I mean, low margin products or commoditized product category, that's been flattish because of the destocking, but in the channel.
Correct. And if you just take we have some new capacity which has come in. We're also planning for more expansion. If you could just give us some sense in terms of how you're seeing volume growth for the company. One, two is how the product mix changes, and thirdly, our margin. If you could give us some guidance in terms of how that will play out over like slightly longer term.
So Madhav, if you see in the starting of this financial year, we had given the guidance of 1,000 crores revenue by FY23, right? So we are sticking to that. This year, so far we have achieved 50% revenue growth. So hopefully we are confident that Q4 should be strong as well. So we are on track to achieve 1,000 crore turnover by FY23 by next year. Right. So this will be on the back of whatever capex we have completed so far. Our last capex was in Raipur. Now beyond this, we are already sitting on the drawing board to see that how we grow our revenues incrementally above 1,000 crores from FY24 onwards. So we have identified a few product categories where we are reaching the maximum utilization levels, like CPVC, bathroom fittings, etc. So we are going to expand our capacity in these product categories. Whatever capex will take place, it will be funded from the internal cash flows, and also we will stick to our guidance that we won't spend more than 30% of our EBITDA towards the capacity expansion spends. Right. So within these parameters, we will announce capacity expansion plans over the next 1 to 2 quarters. But we believe that after 1,000 crores turnover, we can still grow at 20% revenue CAGR over the next 3-4 years.
And then margins should get a bit better, no, as the mix changes towards.
Yeah. So right now, as we speak today, the 9 months, the volume, the building material sales mix was 55%, which was below 50% last year. This year, we have reached 55% levels already. And on 1,000 crores, it should be like upward of 60%. And like I said, all the incremental new capacity will be towards value added mostly. So eventually it will go to 70-80%.
One last question that I have is, generally in this industry, don't you think like we should guide in terms of volumes in metric tons and margins also on a per ton basis rather than percent margins, because commodity input is just passed through always. So I don't know if I'm missing something there.
I think it's a valid observation. I mean, internally we do make business plans based on EBITDA per ton, to be honest, Madhav. But because the investors and analysts they have been using EBITDA margin in their spreadsheets, So that's why we talk about margin during our investor communication. But yes, on EBITDA per ton, I think 17,000-18,000 rupees per ton kind of levels where we see we should stabilize. And as our volume mix keeps on improving, we should inch towards 18,000-19,000 per ton.
Got it. Okay, thanks a lot.
Thank you. The next question is from the line of Udit from Yes Securities. Please go ahead.
Yeah. Hi, sir. Thank you for taking up the question. Could you give us the utilization levels for the quarter and also the same for Q3 of last year?
So that time, the volume, what we did in Q3 was around 13,000-14,000 ton, right, on a capacity of 125,000 ton. So utilization levels you can calculate. But this 125,000 ton it doesn't have the seasonality factor. So we believe taking this seasonality into factor, we may be able to do 80,000-90,000 ton of annualized volume on this existing capacity. Right, so a run rate of like 52,000 ton on an annualized basis on a capacity of 80,000-90,000 ton, we should be at 55% utilization levels.
And just like we have said that the value-added products have been going up. Can you just give the split that how much was it for this quarter, the CPVC fittings and HDPE, and a percentage to our total volume?
So we don't want to be like too much specific on the product, the sensitivity of the information. Overall, the value-added portfolio was 55% of the total revenue. This contains CPVC, fitting solutions, the PVC pipes towards housing applications, and bath fittings, solvents, and water tanks. So this is the portfolio what we call our value-added or building material product portfolio. And in the agri side, we have general PVC pipes and HDPE pipes.
Right. And just last question, like what would be our discount that we offer as compared to leading players in PVC and CPVC?
So normally the 4%. So that's the extra sweetener what we offer our distributors.
I'm sorry, Anubhav, I missed your point voice over there. If you could just repeat.
3 to 4%, Udit.
That is in PVC, right?
Across category, yes.
Okay. Thank you.
Thank you. The next question is from the line of Bhargav Buddhadev from Kotak. Please go ahead.
Yeah, good afternoon, team. My first question is on EBITDA per kg. So if we compare to, say, leading players, our EBITDA per kg is still about 40 to 50% lower. When do we sort of expect this gap to sort of narrow down?
See, Bhargav, there are like 2-3 factors why we are at.
Sorry, I can't hear you. Hello?
Members of the management, please confirm if you are able to hear us.
आपके द्वारा डायल किया गया नंबर अभी व्यस्त।
Request all the participants to please stay connected while we reconnect the management. Ladies and gentlemen, the line for the management is reconnected. Thank you, and over to you, sir.
Thanks. All right. So the second point, what I was highlighting was that today we are utilizing 50-55% of our capacity. So we are operating in an environment of a bit of negative operating leverage. So as our utilization levels will inch up, you will see that the EBITDA spread will also improve. Thirdly, the third factor is the extra discounts what right now we are offering to our distributors to get the market share. If you see in last 3 years, we have grown at the fastest pace in the industry, and that's why we also offered a bit of extra sweeteners to our clients. So as the brand is becoming prominent, right, all the brand pool we are trying to create for our products, etc., we expect that our premium should go up, right, versus discount what we are offering today. So mix of these three factors, we also believe that our EBITDA spreads have a lot of scope to improve, right. I don't want to throw a number today, whether we should be 20,000 per ton or 25,000 per ton, but our endeavor is that every year you will see the improvement irrespective of the fluctuation in the PVC prices.
Yeah, so once we achieve sort of optimum utilization across the west-south plants as well, is the EBITDA per kg gap between these manufacturing plants going to be substantial or would be sort of very minimal?
No, definitely. The EBITDA per ton plant-wise will also improve. And also Bhargav, if you look at our ROC, right, so the investments what we have done into plants. So right now our focus is to generate better ROCs with higher turnover. Okay, so are we able to churn our capital more and more? So if we have to say compromise a bit on margin, we are okay to do that, right? First we achieve the scale of 1,000 crores. Our next goal is 2,000 crores. I guess once we achieve that scale, then we will have much more brand prominence and positioning and pull factor, which will help us realize better realizations, right? So I guess we are okay with marginal improvement in EBITDA spreads because of this discounting, as long as we are achieving 25-30% return profile. So you will see that this year we would be like near 20% levels. Next year we would be 25% levels when we achieve 1,000 crore turnover. So right now the focus is more on return profile rather than margin spreads.
And lastly, as a percentage of revenue, what would be the contribution from tanks and bath fittings now?
Yeah, so put together total, it should be around 5 to 6%. Next year target is to take it to 10%.
Okay, thank you very much and all the very best.
Thank you. The next question is from the line of Kushal Jajodia from Kushal Jajodia and Associates. Please go ahead.
Good morning, sir. So this quarter we have actually added 2 brand ambassadors, Ravina Tandon and Tiger Shroff. So just wanted to know the expenditure incurred on both the brand ambassadors on advertisement per se.
Right. So far, we have spent around 1.5% of our sales value on branding, which is pretty much under budget. Okay. In fact, we had guided for 2% kind of 2% of turnover as the ad spends, but we could manage at 1.5%. The total in terms of value, we have spent around 7 to 8 crores so far. So the run rate is around 2.5 crores on a quarterly basis. Q4 also should be same. Next year we would be hitting a bit higher, maybe say 2% of the total revenue, as we will launch TV commercials.
The second part is, are we capitalizing it as an intangible asset or are we considering it as a revenue expenditure in the P&L?
It is zero capitalization.
Is not capitalized, okay. And just wanted to know because in this quarter we have actually incurred we might have incurred on the bonus issue expenses. So that has hit the P&L, and what's the quantum of that?
No. It is, Mr. Kushal, we cannot understand your question because in case of this distribution of bonus, that comes out of my reserves or surpluses.
Okay. So that's not hitting our P&L item, right?
Yes, that's right.
Okay. And just a last question. How many dealers and the distributor networks we have added in the quarter 3?
It is more or less same. We are not added too much of the distributors, but of course on the dealer side we are working towards the distributors for the retail sales network. So distributors are almost the same as per the last quarter is, but of course the dealer network is increasing. That's why our total top line is also increasing.
Okay. Thank you so much.
Thank you. The next question is from the line of Anika Mittal from Invest Research. Please go ahead.
Hello. Am I audible, sir?
Yes.
Good afternoon, sir. My question is, in our presentation at one place, it is mentioned that there are various pro-growth measures undertaken by the government, especially towards the rural infrastructure and the agricultural space. So this will benefit our company in the terms of growing demand. But if I'm not wrong, our strategy is to focus on the value-added products, that is basically on the building side. So it seems like from the information given in the presentation, we are again going towards the non-value-added side. So can you please correct me or provide any color on the same, that why there is a sudden change in our strategy?
No, there is no change in strategy. In our presentation, we highlighted the opportunity lies in the agri side, right? If you look at our performance for last 2-3 years, every year our sales mix has improved towards building material side, right? Last year we were 45%. Before that we were below 40%. This year we have achieved 55% so far. Okay, so our distribution, penetration, expansion, our product addition into our portfolio, everything is linked to our strategy, which is going more towards value-added products come building material side. In our presentation, we have given the opportunity which lies towards the agricultural side, as the government has a strong focus on rural markets and farm income, etc. So if it makes more sense for us to increase our volume, we'll do that. If it doesn't impact my working capital cycle, which we are very much focused upon. But there is no change in the strategy. I guess there is some confusion at your side.
Okay, right. That makes sense. Okay, right. And my second question is, it is mentioned in the presentation that the company has improved gross margins due to some cost measures or the contribution from the value-added products, and that is looking also, you are saying 55% is from the value-added side. Then can you please tell why there is a fall in the operating margins by 9% year-on-year? What could be the reason for that?
So if you see in Q3, because there was high volatility in the PVC pricing, so there was channel destocking which took place in the third quarter, right? Before, like in month of October, the PVC prices increased by 20 rupees per kg, and then over the next 2 months they fell down, right? So there was a lot of uncertainty in the trade community, and there was destocking which took place. So just to push sales, we offered a bit of extra discounts to the distributors, and that resulted in the sales in better sales volume and better sales value, right? Which a few investors appreciated as well. Now YOY, there is also another factor. Last quarter in Q3 FY21, there was some because PVC prices were going up, so there were inventory gains for the whole sector, right? Our margins were like 18 to 20%. So we had been communicating that those margins were not sustainable. Every PVC pipe company had the element of inventory gains in FY21. So it helped us also. We have always maintained that our core EBITDA margin should be 13 to 15% without any inventory gains or losses.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. My first question was I wanted to understand volume growth. I appreciated you hinted that value-added products like CPVC fittings and tanks have actually grown at a considerably higher pace. Is it possible if you can provide some more color over here? The reason why I asked this, based on my understanding, I think last year's volumes, what we had indicated on the calls was PVC would have accounted for around 70% of it, And I was just going through my notes, wherein I find if I just sum up CPVC fittings others, it would be around 25% of the volumes, and the balance 25% could be HDP or something else. So just wanted to understand if we factor the 25% pie CPVC fittings others also to grow at say 50%, it still leaves other segments, either PVC or others, which would have declined sharply. So just wanted to understand if you could provide some more color segmental wise, that would be very useful.
Right. So Ritesh, I mean, in terms of commoditized sales, right, and even the PVC pipe toward building material, that's the segment which has not grown. In fact, the commoditized sales volume would have come off year on year, right? So your observation is right that whatever volume growth which has come, it has come from CPVC, the fitting solutions, and the other value-added products.
Okay. So should one assume, say, the PVC volume decline upwards of like 40%, of which agri would be far higher than that?
You mean 40% volume decline?
Yes.
No, that's incorrect.
Okay. So would you be able to indicate basically if within PVC, agri and non-agri, what sort of degrowth we had or growth we had?
No. Non-agri PVC was flattish. It didn't decline.
Okay.
Agri PVC declined.
Okay, this is helpful. Okay. So this is one. Secondly, just wanted to have some sense on the sourcing for both PVC as well as CPVC. I think our numbers for import sourcing used to be higher. So if you could just highlight how much is it right now for both PVC as well as CPVC?
Actually, we have, like we have told you earlier, we have shifted our buying strategy from import to local sources. So right now we are buying almost 40% of our purchases from local sources, from domestic sources, and 60% is from imports.
Okay. And how would it vary for PVC and CPVC? I think CPVC is
100% import. It doesn't get manufactured in India, so we have to rely on 100% imports.
Okay. And this number 40% local, what would it have been last year? I'm just trying to understand.
Last year it was somewhere around 25%. You can say 20 to 25%.
Okay. And sir, now one last question. Have we faced any shortages on CPVC, or basically we hear that a lot of industry guys, they are actually facing, and hence the larger guys are actually benefiting. So you indicated that we have grown in the segment. So it definitely gives comfort on the sourcing. Any thoughts on this particular variable, sir?
No, actually, of course, there is a problem in sourcing of CPVC, but we have got our regular sources with us, and we have been working with them for years. So right now, touchwood, we are not facing any trouble in our sourcing. Whatever the increased quantities we are right now having, we are getting them from the suppliers. Of course, going forward, if we are eyeing further 100% or 50% growth in the coming days, then we have to see that to improve the sourcing. But right now, we are comfortable with our sourcing.
Right. And sir, one last question. What sort of inventory would we have at the company level, and how do we read into this? Basically, if the anti-dumping duties against US and China are actually taken off, the local PVC prices could see a further decline. How are we acknowledging this variable when it comes to stocking up inventory at the plant level?
Yeah, actually, the market has already discounted on the basis of anticipation of this drop in anti-dumping, because it was due in the next 10 to 15 days it will be removed off. So market has already discounted on that account, and many of the imports right now is coming from China, where there is no anti-dumping from 15th of Feb, I think so. That is the exact date. So many of the importers have already started importing from China. So the prices have already been corrected on that account. So we don't see any price correction in this, and rather we see a price ticking upwards in the next few months on account of shortages, which are actually seen because of COVID going all across the world.
Sure. So this 130, 131 rupees of pricing what Reliance has, it's reflecting import parity, assuming this anti-dumping duty is taken off. Would that understanding be correct, sir?
Yes, sir. Yeah, exactly.
Okay, great. This is very, very useful, sir. Thank you so much.
Thank you. Before we take the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, thank you for taking my question. Just one clarification, as you had mentioned that your CPVC and fitting contribution has increased. But if I compare with the peers who has reported their numbers, their realization improvement on sequential basis on the higher side as compared of yours. So is it because of just pricing the realization, how the improvement across the board has happened, or is there an element for a PVC or a CPVC and the fittings also included in you? So just to give you numbers, like a 10 to 15% increase for them versus yours is a 6% on sequential basis.
Yes. So if you see, I mean, our net realization is 152 rupees per kg against 143 rupees per kg, right? This is the function of I mean, whatever average pricing would have gone up in the PVC as a raw material, plus the value-added mix, which has more or less remained constant Q3 versus Q2, right? We haven't gone through the detailed financials of other industry peers, so we can't comment on that. I hope we are clear.
Mr. Sahai? Seems like we lost the connection for the current participant. We move to the next question from the line of Ronak Vora from AUM Advisors. Please go ahead.
Hi, sir. Am I audible?
Yeah, go ahead.
Yeah. Sir, I just want to know how's the demand as an industry-wide in the agri and the plumbing segment for us?
So Ronak, the demand in building material has been strong for us as an industry. Also, the things are looking up. The industry reports on real estate construction, they have been quite encouraging, right? For us, we are gaining market share constantly because of our efforts towards network expansion, creating brand pull through advertisement spends, and expanding into newer geographies and adding new products. Right, so we have outperformed the industry in terms of volume growth, in terms of revenue growth over the last 2-3 years. Our market share used to be 1%, now we are at 2%. That's the change in the last 3 years. We expect to grow at 20-25% over the next 3 years.
Okay, sir. And what about on the agri part?
Agri, I mean, as a sales mix, you will see this will constantly go down, but in terms of absolute number, there will be marginal growth, right? As a company, we are working on two strategies. One is to keep the working capital days optimal, and second is to have the margins in the trajectory of 13 to 15% or EBITDA per ton of 17,000-18,000 per ton. So any opportunity in agri which ticks these boxes, we will take it. Otherwise, we are happy to focus mostly on the value-added products.
Okay. And sir, when we said that over the last 3 years, we've been giving heavy discounts to the distributors and gaining market share to create a brand for ourselves, correct? So, and obviously that is truly visible with the market share that we have taken as of now from 1 to 2% in the last 3 years. Sir, where do you see your company in the next 3 to 5 years going ahead? Like, do we see ourselves reaching 10% or, going from say 2 to 4, just doubling in the next 5 years?
Right. So as a company, the next target, the next milestone is 1,000 crore turnover, 250 crore quarterly revenue run rate, which we believe to achieve in FY23. From there, our next plan is to touch 2,000 crore revenue in 3 years.
Okay, sir. Thank you.
Thank you. The next question is from the line of Aditi Kasbekar from an individual investor. Please go ahead.
Hi, can you hear me?
Yeah, please go ahead.
Thank you for the opportunity to ask the question. So my question is more on the competitive landscape side. On the agri side, what we've been hearing is that, there has been like this increase in the prices and the increase in overall like unit pricing at a unit price level is actually causing a lot of the market to move to the unorganized sector. So one, I would like to understand what's your view on that. And then second question is, on the building materials side, pipes as a segment, because of, the demand that we are seeing from the real estate cycle turning up, etc., has actually attracted a lot of competition from the organized market. For example, I was reading somewhere that the Hindware brand, which used to be like a sanitary ware brand, has also launched launched their own pipes brand called Truflo. And in the South India market itself, they're targeting a run rate of about 150 crores per quarter. So what's your overall view on, the organized sector competition in the building materials segment and unorganized gaining share in the agri segment?
So Aditi, coming to the agri side, yes, because of the increase in pricing in the resin, the market for branded players, for organized players, has shifted to the unorganized sector, which uses inferior quality raw material, right? And this happens across the industries. And this is the reason that why our agri PVC sales have declined in terms of volume on a YOY basis. So we are letting that market go off, right? We are not chasing that segment at all, right? We don't want to compromise on our margins there. So we are happy to let go that market, and this is the industry-wide phenomena. So we, as a company, as an individual participant in the industry, we don't want to chase those sales. So we'll wait for PVC prices to stabilize or whatever, and if the market comes back, then we are ready, right? Our capacity is there, our distribution is there, our brand is there, our network is there. So we'll wait for the better times to come. In that agri space, right? We don't want to chase the volume there. Now coming to the competition increase in the building material space, yes. But see, we need to understand what has happened in last 3 years, right? It is not a 6 month phenomena or 1 year phenomena. In last 3-4 years, if you see the top 15 players, right? Barring the top 5 players, there has been the massive shift in the market share below top 5 players, right? Because of demonetization, GST, NBFC crisis, COVID wave 1, COVID wave 2, lockdown restrictions, etc., a lot of weak or small organized players have gone away from the market, right? Or they have become even smaller. So at the cost of those small organized players, weak organized players, there have been companies like Apollo Pipes or some names which you took. They have been taking market share. They have been inching up their market share, right? So, and plus the industry has also started growing, right, which was a bit of flattish growth because of all the factors which were impacted due to the GDP performance in India. So I guess now there has been shift from if you look at 7, 8, 9, 10 till 15, there has been big change in these rankings, right? So companies when we started going pan India with a turnover of 250 crores 3 years ago, we were number 10 player, and our market share was not even 1%, right? So from 10 we have come to position 7, right? And the immediate player above us is also having financial trouble, right? So the companies, the new companies, existing players, they will keep on taking market share at the cost of these weak or troubled companies, and the new generation of companies will emerge. So as of now, we don't see intense competition in our space where we are growing, right? We have also our right to win at many places. Our brand, overall APL Apollo brand in building material is very strong, right? Then the work what we have done towards the network expansion over the last 2-3 years, now it has started paying off. The work what we have done towards the capacity creation across India, now that has started paying off. Right, the work what we have done towards adding new products to our portfolio, Now those products have started ramping up and they are contributing to our top line and bottom line. The work what we have created towards our PVC pipe brand positioning, right? And that has started paying off. So we are ready with all these ingredients and given the support we are getting from the construction activity and the macro factors started to play well. I think whatever numbers we are talking about, whatever goals we are talking about over the next 1 year and 3 years, we are confident of achieving those numbers.
Understood. So basically, it's weaker players sort of weeding out of the market that's helping you out to gain the share.
Everyone out, yes.
Understood. Thank you, sir. Thank you very much.
Thank you. The next question is from the line of Siddharth Purohit from InvestQ Invest Advisors. Please go ahead.
Hello. Am I audible?
Yeah, please go ahead.
Yeah. So on the overall industry level, if you could give some sense of, what is the level of capacity that the large players are also planning to add, and will there be a situation? No doubt there is demand is quite strong in the last 1.5 years time, but is there a likely situation that because all the players are generating enough cash, so is there a situation that probably we might see some more of incremental addition which might lead to sort of pricing pressure going ahead? That is one part. Second is, given that there has been an inflationary trend in almost all the spheres, what could be the capex, incremental inflationary capex cost for a ton, say, if let's say we go for a new plant, greenfield plant, basically.
All right. So coming to the first question, we also interact with our industry friends, right? So I guess the overall belief is that this industry should grow at low double digit now after a pause of 2 years. So everyone is getting himself ready to achieve those kind of numbers. Obviously, the larger players have much larger capacities. So for them to grow on a base of what they are today, so they are targeting a double-digit growth. But for us, at such a small base, we believe that we could grow at much faster pace than what the overall industry will grow. Plus, the other players are also getting into a lot of other product categories. We have seen PVC pipe companies getting into adhesives, solvents, etc. in a big way. So they are also identifying other product areas where they can grow. We have our product portfolio where we want to expand, right? So I guess there is enough scope now that the industry should start growing at double digit, maybe low double digit, but you will see that happening given the support what we are getting from the real estate sector and the construction activity. Second point of yours, which was regarding capex. So yes, there has been inflation. Every building material product has gone up. So the project cost will go up by 5 to 10%, which could depress the IRRs and ROCs a bit. But then we are not too much bothered about it because whatever new capacity we are going to create, that's going to happen in the value-added products, which give us very high margins, right? So we are not too much. We don't think that our ROCs or IRRs would get depressed because of the price inflation on our capex side.
Okay. Sorry, sir. Thank you.
Thank you. The next question is from the line of Amit Zade from Antique Stock Broking. Please go ahead.
Thank you, team, for the opportunity. So my question, first of all, appreciate the fact that you are still guiding 1,000 crores of top line for FY23, despite anticipating price correction in PVC, so which warrants more than 45 to 50% kind of volume growth for the next year. So, sir, my question is, what kind of dealer addition will that require, considering the fact we must be close to 600 dealers as of now? And what kind of dealer addition will that require to have an incremental sales of 300 to 400 crores if we end up this year at almost 700 to 750 crores? And in what geographies will this happen?
Right. So I mean, coming to the main point about the 1,000 crore turnover. So 9 months we have done, say, whatever number, 550 crore kind of number, and if we just annualize this number, we would end the year at 750 crores, annualizing the 9-month number.
Correct.
So this suggests 30% growth, 35% growth to achieve 1,000 crores. Now this 30% growth is divided into 20% volume growth and 10% realization growth. Right. So right now for the 9 months, our realization is 142,000 rupees per ton, which we believe should be, like, irrespective of PVC prices here and there. We should see some improvement in our realizations based on simple fact that our value-added mix is improving. As our CPVC will go, as a mix will go up, our fittings will go up as a mix, our bathroom fittings, water tanks, etc. will go up as a mix. So that will automatically improve my realization. So this 30% revenue growth is broken into 20% volume growth and 10% NSR growth, right? So yeah. So and to achieve 20% volume growth, yes, I mean we will have to work towards expanding our distribution network. So far, 65% of our turnover is still coming from North India, right? So as our plants have started contributing from Raipur, from South and from West, so over the next 12 months, we are going to add new distributors. Our target is to increase our distribution base by at least 5 to 10%, right? And that will be mainly in the southern and the western geographies. Now that we have support from our production plants, manufacturing facilities.
Got it. So North India contribute almost 65%, you said, right?
Yeah, that's right.
In this quarter, which was what, 80% same year last quarter? 75 to 80?
Of course, because South plant we had just taken the possession from the seller in the mid of FY21. So yes, the contribution was very little, and Raipur started only in the Q1 of this year. So Raipur and South contribution started flowing from FY22, to be precise. And with our new addition of distributors in the West market, our Ahmedabad plant has also started ramping up quite strongly.
So fair to assume 50% contribution from North India by end of FY23. Which used to be 75-80% 2 years. So
that will be for FY24. FY23, 55-60% we may close from North India.
Okay, sir, got it.
Because in North also we had done some brownfield expansion.
Right.
Right. So that's why.
Okay. Okay. And also, sir, you suggested some greenfield expansion that could happen. So that would be for a next phase of growth, right? Which we are targeting from 1,000 crores to 2,000 crores. That would be probably for.
That's right. Yeah. So just to be on record, any capex what we will do, it will have 3 checks. One is that capex in a year will not exceed 30-35% of our EBITDA. Second, the capex, any organic capex will be funded from internal cash flows mostly without stretching much of the balance sheet. Third, any capex, incremental capex which will take place will be mostly towards the value-added products and where the ROCs or IRRs will be above 25-30%.
Okay. So sir, this EBITDA per kg of 17 to 18% which we are currently doing. So what could that maybe stabilize once we reach all these expansion?
So see, I mean, for 1,000 crore sales, where we believe that 60% of our products will be from value added. So I guess. I mean, we should be doing 18-19,000, and then eventually it will inch up by 1,000-2,000 per ton every year if the sales mix keeps on improving. So given that our competitors do 30-35,000 per ton, I mean, but for them the sales mix and the realization, etc., operating leverage, the premium realization they get, everything comes into play. right? So our immediate target is to hit 20,000 per ton, and then we'll see how we can achieve 25,000 per ton in the long term.
Okay, got it. Thanks a lot.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Hi, sir. Two questions. I just wanted to have a sense of what is the current inventory in the company. Hello.
It should be hello, yeah. It should be in line with our. It should be somewhere around 2,500 tons, roughly around. You can say that. I don't have the exact. Yeah.
Okay, so this would be resin or finished goods, sir?
Yeah, it's a resin. It's a resin.
And sir, I'm assuming, given we indicated that still we have increased our local sourcing, but still 60% would be imports.
Actually, because of that very strong, you can say, drop in prices in the month of this November, this actually impacted us. Like Anubhav already told that we were anticipating much higher sales as what we have achieved this time. Yeah, we were in anticipation of much higher sales. Because of that, there was a little pile up of the inventory which will be, you can say, liquidated in this current month.
Correct. But sir, then if one had to understand it, I think the surprise came on volumes, which was lower in the month of November and December. So the carrying cost of this inventory could actually be higher, right? Given the volume throughput in the month of November and December was lower. Please correct me if I'm wrong.
Ritesh, it won't be much because the incremental inventory which was purchased, right, as a company, we always maintain 2,000 ton to 2,500 ton kind of levels, right? I mean, how much we would have fallen short of the volume? We did 14,000 ton, right? We could have done 500 ton extra if the destocking had not taken place. So 400-500 ton on a total base of a bit of high inventory cost, it won't have like very big impact on P&L or on the balance sheet.
Right. Anubhav, the sense what I'm trying to get is basically if one looks at October, November, and December resin prices, September to October it moved up very sharply, and November it was around 162, went to 148, and then to 140, and currently it's hovering at around 130 levels. So my assumption is basically even if we have say around 2,000 tons of rolling inventory, the average costing over here will be upwards of 140, 145 as against the prevailing prices. So is the expectation that the end product prices will move up incrementally and the probability of inventory loss will be lower into Q4?
Yeah, Ritesh, actually if you see that there was an increase in Q3 in the resin prices in October month was 20 rupees. Then again the drop was there in the month of November, that was 20 rupees. Then the increase was almost $30. And there was no further drop in the month of December. December was almost stable. Of course, because the destocking was there, because of that the buying was low on that account. But there was no price change in the month of December. Again, in the month of January, there is a price correction of 9 rupees per kg. But now the market has again started moving up. So we don't actually foresee any inventory loss in this quarter. And further, if just again 2 months are left, and we don't actually know that what exactly the prices level will be in the next 2 months. So it will be a bit of, you can say, early to comment on these parts. Rather, we should like to comment on these on the Q4 results. But we don't see any such big loss or any, you can say, any inventory loss on this account.
Right, and just in addition, Ritesh, if we assume a worst case, okay, let's assume that 500 ton extra inventory that would be in the system, it was at high price, right? And if the prices fall by say 20 rupees a kg or 30 rupees a kg, so on 500 it will be like 1.5 crore to 2 crore, right? On my quarterly bit of 25-30 crore. So I think that much risk any company who wants to cater to so many dealers and who wants to service so many SKUs, we have to take this much of extra inventory on our books always.
Correct. I appreciate that. I think it's an industry-wide problem, and it's because of the volatility, unfortunately, in resin prices. But if I had to connect my earlier question with this one, basically I was just looking at the resin price average for the month of November and December. It was at 150 bucks. Currently, what we are sitting is around 130 levels.
No, it was Ritesh. It was 140 in the month of end of November. It was 140. Then there was no price change in the month of December. Again, in the month of January, there was a drop of 9 rupees per kg.
Correct. Sure. That's helpful. My second question is, sir, you indicated that the current pricing is already adjusted on import parity basis. I just quickly did some math. Can you help me understand how actually it stacks up? Because if I factor Chinese prices at $1,300, there are two elements over here. 7.5% is the duty, which I assume, given China is non-FTA, this will come over there. And there is another element of around $148. If I loop in both the variables and factor in a higher freight cost of say around $100, still the implied resin price what I get on landed basis is at around 120 rupees, which is lower than current 130.
Let me correct you. First of all, the Chinese prices is right now around $1,250 or $1,270 FOB. It is not CIF dollar prices. You have to add around $250 to $270 per ton on the freight part on these prices. Secondly, the duty is 10% plus additional duty of 1%, totally 6% of duty is there. So if you calculate all these things, the prices are at par with the Reliance prices right now what Reliance is offering to us. So there is no such major price correction on that account in the resin prices.
This is useful, sir. Sir, you said 1270 and 270, right? And
$1,500, yeah, roughly around $1,470 to $1,500. Again, there are lot of, you can say, the deals cancellations are also there from China. So a lot of people don't actually go with the Chinese company to deal with resin because whenever the prices increases, they just decline the deal. So that is again a challenge with the Chinese prices. Other than that, the normal PVC prices from other countries, it is somewhere around $1,500 to $1,550.
Sure. So this is very, very useful. Sir, you said 270 for China to India, and how much would it be for US to India?
I don't know because right now there is no the PVC is coming from US market because of the shortage already running at their end.
Sure, sir. Thank you so much. Thank you. Thanks, Anubhav. Thanks, sir.
Thank you.
Can we take last question, please?
Sure. The last question is from the line of Karan Batelia from Asian Market Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, two things I wanted to understand. Agri season was a washout since last couple of quarters. So do we see some pickup there because, how far can farmers delay their purchases? So any comment would be helpful on this. And how has been the ramp up at the Raipur facility? Is it on track compared to our expectations or how is it shaping?
So see, agri sales have been declining for the organized players, but as an industry, the agri sector is doing good, right? It is just that the volumes have shifted towards the unorganized sector who work on the inferior raw material for the end product, right? So we don't expect agri to come back unless until the PVC prices go down drastically from these current levels, right? Having said that, the project sales which come for the irrigation sector, etc., and the government schemes, there the quality is all up to the mark. So there the sales are happening anyways, okay, for the organized sector also. What was your second question?
On the Raipur facility, how has been the ramp up? Is it in expectation to our earlier estimates?
Yeah, Raipur is ramping up quite well. It has given us access to the eastern market and central Indian markets, which were difficult to feed from our north or west plants. So yes, it has been ramping up as per the expectation. Total capex was 15 crores. At the peak, we were expecting 50-60 crores of the top line. So we should be able to achieve that by next year.
That was very helpful. Thank you for this.
Thank you. I would now like to hand the conference over to Mr. Manish Mahawar for closing comments. Over to you, sir.
Yeah, thank you, Steven. On behalf of Antique Stock Broking, I would like to thank the team of Apollo Pipes for providing us an opportunity to host the call. Mr. Jain, would you like to make a closing comment, sir?
Yes. Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team. Thank you once again for taking the time out to join us on this call.
Thank you. Ladies and gentlemen, on behalf of Antique Stock Broking, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.